Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Judith Mackenzie of Downing Fund Managers to talk about the Downing AIM Estate Planning Service. Hello Judith, welcome to the studio.
Hi,
We're here to
Jonathan.
talk about the AIM IHT service. What does it aim to do for investors?
Well, first of all, government gives these tax reliefs for individuals holding AIM stocks for 2 years. And after 2 years, they go out with your estate for inheritance tax purposes. So that's one reason to do it. And investing in AIM is quite an exciting place to be, actually, and hopefully we'll come across some of the attributes of it as we talk today. But it's not just about capital preservation, it's about growth. And why invest in our AIM service? Well, we've got the track record. We've been doing it for over 13 years. I've probably been doing it for over 19 years. And over the last 13 years, we've got a compound annual growth rate of about 9%. And actually, you're getting exposure to great UK companies. So investing in the UK is a good place to be.
And for those who aren't familiar, can you give us some background to Downing and your role there?
So yes, I started Downing Fund Managers now about 14, 15 years ago, and really it's the boutique asset management arm of Downing. So we're investing in small cap companies typically, and so it's not just my part of the business, the AIM IHT service, but we've also got other mandates as well. But we've got a common theme, and we've all got this kind of bottom-up, focused, diligence-based approach to investing.
So in the AIM service, what sort of companies are you looking to invest in? What are the key characteristics?
So first off, we're investing in companies that are under 500 million market caps. So that's probably, compared to our peers, maybe the smaller end of the market. But we like investing there because they're cheaper and there are more companies and there are fewer analysts looking at those companies. So if we do our homework well, we do our due diligence, then we get an informational advantage to be able to invest in these companies probably before many other people would be investing. And so they're much cheaper, there's more of them, and they're quite attractive.
Are there any particular sort of common traits within those companies?
Yes, so we like cash earnings, not accountancy earnings. So what that means is that we're looking for companies that are really good at deploying their cash, so management teams that know how to deploy cash, but also companies that are great cash generators. So that tends to mean that they're not overgeared, they don't have a lot of debt, and they throw off cash. And if they do that, they can pay dividends or they can reinvest their capital into their own businesses.
And it looks like you also skew away from some of those higher valued companies with a lot of their values in the future, they're going to grow at rapid rates. You focus more on, I guess, cash today.
Cash today, absolutely. We don't really want to pay up for future earnings. So it probably means that we're quite biased towards industrial manufacturing companies. We're not really doing anything that's blue sky technology. But we quite like that because we can touch and feel the earnings today and we're not putting a bet on future earnings.
So Judith, are there any companies or sectors that you look to exclude from the portfolio?
From a sustainability perspective, we don't invest in controversial weapons and we don't invest in companies that are really heavy on the environment. That being said, we've never invested in those types of companies, but we're not always bound by hard and fast sustainability rules. We believe that actually you can get the benefit of investing in a company and to help them improve their sustainability credentials. And very often they're doing all the right things, but their disclosures are pretty awful. So we can work with these companies to make their sustainability credentials a lot better through a couple of years. So we don't just disregard companies because they might be in sectors that are slightly less popular when it comes to ESG.
So Judith, can you give us some recent examples of investments you've made in the portfolio?
No. No, I say no because we don't disclose what the most recent investments that we've made, only on the basis that we manage liquidity quite carefully. And that means that when we put something into the portfolio, we do it deliberately, probably about 1.5% of the portfolio. Some of our higher conviction, longer investments would be in the portfolio at 5%. So when it goes in at 1.5%, we're hoping that we get, we've done the initial diligence, but we're hoping that we can get the liquidity, we can test out the liquidity, but also get to know the company a lot better through starting to own it. So in that period, so from say 1% to 2 or 3%, we don't tend to talk about them. So I'm not going to tell you about them.
Oh, very good. So keeping your cards close to your chest.
Yep.
And I guess that's because you focus on some of those smaller companies,
Yes.
sub 500 million market cap.
Yeah.
So turning to some of the more established names in the portfolio, can you share any details there?
I could do that. So we've got one business that I first invested in 2016, believe it or not, and that's a business called Cohort. And Cohort is a defence business, and it's done very well recently, obviously, with defence budgets being changed quite dramatically over the last sort of 12 months or so. But it's been a business that actually has survived through those 15, 20 odd years and grown its earnings. So when we first invested, it had EBITDA earnings of around about 14 million. Now it's coming up to about $250 million. So although the share price has grown, also the earnings have grown. And that's been through acquisition, but it's also been through organic growth. So this is a management team, going back to the point that I was making at the start. We like businesses that can generate cash, but also management teams that are very good at allocating capital. And that's a management team that we're very proud of.
Ah, very good. Any other examples?
Yeah, another business that we've got in the portfolio is Volex. So they manufacture cords and cables. And again, when we invested in that business at first, we're probably investing when it was about 35, 40 pence. It's now over £3. It had got to about £5. And their end markets were quite attractive for us. At the start, they were when we invested, they were manufacturing things like cables for iPhones. Really not a good quality business, but now they manufacture cables for EV, for electric vehicles, for medical, and some really sort of growing industries. So we identified the growth that could come from those industries when the company was probably in sectors that were less attractive. So again, it's a company that's fared well. And then maybe another one, since I didn't tell you about the other ones that we've got in the early stage of our portfolio development. We've been quite a long-term investor in a business called Ramsdens, and Ramsdens it's in financial services, but if you're to see it in the high street, they're a pawnbroker. They buy and sell gold. They sell FX for you going on holiday, and they're also one of the UK's largest jewellery distributors. So you've got really nice diversification of earnings, and of course, with the gold price being where it's been over the last sort of 12 months or so, there's a nice hedge on that gold price too. And again, a proper solid management team based up in Middlesbrough that have been there, done it and seen it, and real stalwarts of the industry.
Oh, very good. And so turning to the AIM markets, it's been a really tough, I guess, 3, maybe 4 years for AIM. How's that affected the portfolio?
We're stock pickers. You would not invest in AIM as an index if there was an ETF for it. And I think sometimes AIM gets a hard time because as an index, it's been quite volatile and it's not been the best performer over the years either. But I would try and draw your attention away from that because it's all about the underlying companies that are on that market. And of course, at the junior end of the stock exchange, you're going to get quite a diverse range of companies, anything from a £2 million venture company right the way through to some of these companies that I just talked about that are generating millions of pounds in free cash flow. So it is a bit of a mixed bag, and that's why you need to be a stock picker. And actually, we fared okay through that period. As I said, our performance is 9% compound over the long term, so that's over 10 years. And we're up 165% since we started this. The AIM index in comparison is up about 3 or 4%. So don't invest in the index, invest in the stocks.
That's a very good point. So how risky is AIM, and by extension, how risky is your portfolio?
What's risk? It's a good question, isn't it? So I believe that risk is the permanent loss of capital. And so that's when a company goes to the wall. I've had that 2 or 3 times in my career, but only 2 or 3 times. And it normally comes when companies are overgeared, so they've got lots of debt. And again, going back to what I've said, we avoid companies with heavy debt. In fact, most of our portfolio has got net cash in the balance sheet. So that's a brilliant hedge when you're going into more difficult times. So actually we have fared okay because of that slightly more cautious approach to making these investments.
So where are you seeing the biggest opportunities on AIM at present?
Yeah, it's an interesting time. So it's you probably are aware that there's been about 48 months of net outflows from UK markets. and small cap as well. So that has made life challenging, but it's also thrown up some brilliant opportunities. And what we're seeing is that where some other fund managers are having to come out of assets, these companies end up getting even cheaper than they were before. So we're typically buying on low multiples. We're buying on, say, 10, 12 times PE. And the average growth in AIM over the next year is going to be 20%. So if you can buy cheaply and get 20% growth, you're actually going to fare quite well over the next 3 to 5 years. So we're seeing the opportunity actually where others are being fearful. And we're buying in the market on bad days. And we're buying companies that we've known for sometimes 10, 15 years. And that, I think, will fare well over the course of the next 3 to 5 years as well.
Very good. So you may have touched on this question, Judith. So for those who are looking to invest in a AIM service, why should they consider Downing?
We've got the track record. So that's evidence that we do what we say in the tin. We do things a little bit differently. We're hunting in a different area to many of our peers. So you're going to get diversification. You've got the Wealth Guard, which is downside protection. So any investor under the age of 90 gets protection should they die and have lost anything up to 20% of the portfolio. So that's quite a nice to have as well. And you're investing in great UK companies.
Judith Mackenzie of Downing Fund Managers, thank you very much. If you're watching on YouTube, please press like or subscribe to the channel for more.